Okay, let me start the webinar. Good day to one and all. This is Dr. Sivaraman of inoindices.com. So I was presenting between 9 and 9:45 GMT, tracking the forex market together, part 1. So now I will take up during the gap time, 14 to 14:45 GMT, part 2 of the webinar. It is a continuation of this webinar. It is a twin webinar I give once in a month, explaining the simple market tracking technique using the forecast and also the market tracking technique. We decide on the trades. I will take the live call trades and subsequently use the effective trading strategy using the hedging and aim for either way tradings or try to use the hedging instead of stock, and then subsequently try to earn from the market. Because the market is known to make volatile moves and nobody will be able to prevent such volatility, and it is part of the game. So in that process, we need to find out whether the market is in the upward move or a downward move during each swing time. So whenever they make the swings, so today the example was the GBP. So GBP from that of 1.67, it dropped to 1.6656 or 60 level, and again claimed to 1.67 and again dropped it, again gained it. So that sort of moves, they had done it in the case of GBP. It is nothing but the pump and the dump move. So we will see how exactly we can do trades during this particular time of the market. Now it is a gap time. So let us see that the derived forecast is important, and the derived forecast says during the year session, today is 18th, swing and slide move is expected. So that is the derived forecast. So let me compare it with the initial lows and the highs as a market reading and try to see where exactly the currencies are. Now in the case of euro, they are not breached the low, and the initial high was 1.3712. They went up to 1.3749 from there, about 37 pips, and stalled it. And that was around that of closing of the European session. And so we did not take any position in the case of euro during the European session because the spread between the high and the low was very less than 40 pips. So if it is more than 40 pips, then we can initiate a trade. Now it has become more than 40 pips. So it is a gap time move. We will try to watch how exactly they are making a false move in the market. So false move is the one during that phase. They try to come up to that of the high and reverse, or go up to that of the low and reverse without breaching it. And that is referred as a false move. Then in the case of GBP, 67.10 is the initial low. Still they are holding below that. I was telling you that I'll keep a sell limit at 1.6710. After the webinar, they came quickly and filled that order and then subsequently made the drop. I booked a profit. I'll show it. Then again, they are hovering around below that of the initial low, which clearly indicate that they have the intention to slide it. Then in the case of yen, 102.18 was the initial low. Still they are holding initial high. They are holding above that. So they intend to make the gain. Before that, they need to handle the end process. For that, they are making a small move from that of 102.40 to 102.60 level. 20 pip swing, they are trying to make it. And in the case of CHF, they breached the low. So 89.10 was the initial low, and they came down to 88.90, and they are staying below that. So now if you compare it to that of euro is made about 37 pips gain, whereas USD CHF is only showing 21 pips negative net change. So after that of the gap time, here you come across little bit of gap time false move in the case of USD CHF, and then we will see how exactly they are going to that of the high in the case of euro as a false move. Then in the case of Canadian dollar, 1.0947 is the low, 1.0965 was the initial low, and they just went up to 1.0977, and still the spread is less than 40 pips between the high and the low. They are simply making the consolidation and holding it. So if we take any position, we may not be able to get any good profit. Then in the case of Aussie, 0.9016 was the initial low. Then I kept the sell order at 1.9010 level, and they filled it, and they are holding above that initial low now, 1.9028. But the high is far away. The high has not been breached, and still it's showing 4 pips negative net change. So they are making a small swing near that of the initial low, and they just made an extended move above that of the initial low, and they are expected to make the slide during that of the year session. When they firm up during that of the gap time, which indicates that it is a false move to make the slide during the session. So we have just made the analysis of the market. Then I will try to show the trade, what I have done. So this is during that of part 1. I have taken the positions. So in the case of Euro, I have not taken any position because the spread was less. And now we can take a position. And in the case of JBB, I kept a sell order at 67.10. And when I was talking to you in the webinar that it was coming to that of 1.6670 level. So still I kept below exactly around that of the initial low. They came up to 1.6712 and then started making the slide. And when they started coming down and not breached the low for 30 minutes, I immediately booked a profit and made about 44 pips profit. And in the case of yen again, they went up after filling my limit order that was about 5-6 pips below that of the market, and then subsequently they went up and stalled that move. So I have booked about 17 pips profit. Again started making the dip later on. Then in the case of Aussie, I kept 1.9010, and that was filled, and currently it is 1.9028. My hedge is 1.9040. Still it is not hedged. So I will try to carry it to that of the year session, because still it is showing a negative net change and it is likely to make further drop. And at that time, I'll try to keep stop at entry and try to book profit. So these are the 3 positions I just take it. And now, in the case of Euro, they cut the high during the gap time. So now we will go in for the market moves. So this is the gap time, 14 to 14:30 GMT. During that of the gap time, they make the false move. So when they make the false move during the gap time, that means if they make a false move on the higher side, that means they wanted to make the drop during that of the session. So now quickly, in the case of Euro, they are just making an upward stop trend, and here you find that 1.3760, they have showed it. So we will first take a position, later on come to the discussion part of it. So it is a gap time trade. So 1.3759. With 30 pips, buy stop. $1.3789. Okay, they went up to 1.3760. There might be a slight variation from the quote page to that of the platforms. It doesn't matter, but ultimately we need to understand how we need to trade. And in the case of GBP again, 1.6710, they are showing it. 1.6740 as an entry stop or the buy stop. Okay. Then USDN, they just made a small dip, and USD they just made a dip, 88.80. So 88.86 we will. Okay, now the spread has become about 49 pips. Okay, 0.8886 with an entry stop or the sell stop below the 30 pips below. $88.56. See, I'm just showing all the positions, but it is not advisable to take simultaneously so many positions. It may lead to over trading. And already we have the AUD position, which is carry forward. This is a sell position. With a buy stop at 0.9040. Okay, so these are all the, now they have made a further upward move, and GBCHF also they made further drop. But why they are doing such moves during the gap time? See, during the gap time, they make the false move. What is the reason for it? Because the banks officially close all the currency conversion transactions by 14 GMT from that of Europe and also Asia. And the US bank starts by their local 9:30 GMT, that will be 14:30 GMT. There is a gap of 30 minutes. And during that particular gap time, they try to make the upward or the downward move to squeeze and hit the stocks. And if they try to do it during that of the session, what happens? So when they make an upward move during that of the normal session, then the banks will readily go in for the currency conversion and try to sell. And then there won't be any short covering from the bank. So they want the traders to do the short covering. That is why they make the false move during that of the gap time. So here they just made an upward move up to 1.3770. And let us see how exactly they are making the opposite of it during the session. So it is an acid test for us. Now we'll be able to find out whether they are really and the gap time will get over by 14:30 GMT. So meanwhile, I'll keep talking about the market and explain to you with the help of other slide. So we use the derived forecast. So the derived forecast says that swing and slide move is expected during the US session. Then afterwards we fine tune it with the help of the market reading. For that I noted down the initial lows and the highs on a daily basis in the 4 majors and 2 commodity pairs, and also the net change, what it is from that of the previous day close, and then try to find out what sort of moves they are trying to do it. Okay. Besides, we need to use the session timings in order to have the effective understanding, because otherwise if you see the continuous chart, you will not be able to discriminate what session or what time frame they are trying to make use of for the false move, stop and then intentional move, extended move, etc. So the timings are very important. So the US session starts only by 14:30 GMT. 14 GMT, the European session gets over. Then 14 to 14:30 is the gap time, and the gap time moves are always false move. So let us see whether this theory is confirmed in another 14 minutes. Then after noting down the initial lows and the highs and also the net change from that of the previous day, we try to refer that of the initial lows and the highs of the live market quote page and try to relate it to that of the market from time to time and see what sort of moves they are trying to do it. So these are all the type of moves. Less than 30 minutes move, the stop point under the false move. A false move is the one in which they come up to that of the high or up to that of the initial low or up to that of the initial high and reverse it. A stop point is the one they try what they have done it in the case of euro during the gap time. So either during the gap time or during the early session, they try to make the stop point. A stop point is a move which happens in less than 30 minutes. So in less than 30 minutes, they have to reverse and come to that of the initial level. Only then it is considered as a stop point. In case if they stay above that of the initial high for more than 30 minutes, and if it is a quick upward move, then we wait for 2 hours and see whether it is an extended move. Extended move is the one they just form the new high and stop cutting the new high for 30 minutes, but still hold above that of the initial high for 2 hours and then start making the drop. So this we need to understand. And once we understand this, then we will be able to find out what is going to be the next move, which is an intentional move. The intentional move is on the downside, or if they make an upward extended move. So we need to understand that and try to take the positions accordingly. Then the swing is the one which they make between the low on the high or new low on the high. That sort of moves for about 20-30 minutes, or near that of the high they make a consolidation move, or near that of the low they make the consolidation move. And they are all referred as the swings. So they always make the extended move as a quick move, and the intentional move will be a slow move. And they alternate the extended move with that of the intentional move. In between, during that of the session change, they make the false move. And during the session start time or during the gap time, they make the stop end. And the swings during that of the mid sessions. So if you understand the timing and the type of moves they do it, we can easily identify what sort of moves they are trying to do it and then take appropriate decision, what position we can take. Then, in the trading strategy, we use 30 pip stop because always they try to do about 15 to 23 pips as a stop end, and very rarely they go in for 27 pips, and we keep 30 pips as the stop so that they don't fill the stop so easily. In the event if they stop it out and find out whether the stop level is making profit, and if the stop level is not making profit, understand it was filled with a stop and or an extended move, and they intend to make the reversal in the market. Then once they start making the reversal, try to keep stop at entry and try to see what move it is. So if it is a quick upward move, then the downward move will be very slow. If the move upward is very slow, then they may continue to gain the levels. So that way you can differentiate the extended move from the intentional move. Intentional move will be pip by pip move, whereas extended move will be a quick jump in no time. Then always we try to see that the new high or the new low is formed, and for 10 minutes we wait, and that is not been breached, then immediately we take a sell position near that of the high or a buy position near that of the low. This way we can try to take the position. I had taken the position, that is why in a hurry, so that I can show it to you that how exactly the gap time moves or false move, which indicate what they intend to do during the following session. So here, as far as euro position is concerned, which is making about 8 pips loss, and GBP, which is almost flat, and this is also showing nominally about 7-8 pips loss, and AUD, they come closer to that of 90.39, 90.40. If they hedge it, and we will watch whether the hedging is making profit or not for about 10 minutes, and if it is not making it, we'll close and keep another 15 pips above another hedge order and trail it to that of 90-40 once they start making the drop. So that we use the hedging to find out what they try to do it, so that if we use the stop, immediately we may lose the position. Instead, if we use the hedging, we are able to relate the hedge level to that of the market and find out whether it is the hedging has been done mainly to make the opposite to that of our expected move, or it is just a stop and or a quick false move before that of the intentional move. And this we need to understand. For that, it is the ideal condition using the hedge in the position. So they have started making the slide now. So slowly, because it's a live market code page is about, it's delayed by about 15 seconds. So you can just watch it in the live code page or in the platform and find out how exactly the market is making the gap time moves. So if you've got any doubts, you can ask me the doubts and I'll be willing to answer, because during the part 1, I did not have much time to take up the questions. So that is why I made the explanation brief, and those who are not attended the part 1 probably can listen to the recorded webinar of part 1, which is available in fxtrade.com under webinars, and try to go through. And again, this webinar is also being recorded, and you can go for this as a follow-up or just listen to this now, and part 1 you can just listen and find out how exactly my trading system works. So in my trading system, 3 components are important. The forecast is derived based on my forecast algorithm. Otherwise, any forecast for that matter, we try to use it using technical or fundamental analysis. Then we need to do the market trading. Whatever be the type of analysis which will be acting based on the past performance. And you know very well the saying in the market, the past performance need not guarantee the future. So there is always an element of risk. And in order to avoid such elements of risk, we use the market trading technique. The market trading technique consists of the following. So the market trading technique requires only the live market code page to start with. No other tool, we use it. Then we use the market timing. You can take a screenshot, otherwise you can note it down from that of the recorded webinar. And every day during Asian session live market analysis, on Monday and Thursday webinars, I show this, and you can note down the timings. The players follow this time. It is not followed by any of the people or conventionally those who have been talking about the market. But this is the timing followed by the player, because we need to find out the hidden agenda of the players and try to trade in line with that move, rather than simply speculating and simply doing the estimate and say that, use a disclaimer and say that, sorry, the call has gone wrong. There's no point in telling that. Instead, we have to find out how exactly we can read their intention. As long as the players are the human, we'll be able to read their intentions. Any businessman for that matter, when he is having a shop and when the visitor or the customer comes there, he talks to the customer and find out what the requirement is. Or they come for a window shopping, or they are genuine customer. He is able to read it. And if he finds that they have got the need to buy, he tries to convince and sell the product. So there you come across the person is doing the reading of other man's mind. So in any business transaction, reading the other man's mind is very essential in order to convince and conclude the transaction. So that is what we normally say, that convince the other man. And here, the other man is invisible. He is not directly exposed to us, the players. So we have to read their hidden agenda from their market move. Whatever be the hidden agenda, they have to disclose it in the market. They cannot keep it as a closed call. They have to disclose it in the market. So we can easily identify what they are trying to do it with the help of the quick moves, what they are doing. The quick moves are false moves in the market, and those such quick moves when they make, we can identify, okay, when they are making a quick upward move, okay, fine, they wanted to make a slide. When they make a quick downward move, okay, understand that they wanted to gain the levels. So that with the help of the market timings, if you follow, then it will be easy for you to understand. So the first one is live market quote page. The second is the market timing. Then we note the initial lows and highs as reference material, and then find out on a daily basis what they are trying to do it, and compare the market during different times of the day, whether they are above that of the initial low or below that of the initial high, and what they are trying to do it in the market. We try to read their intentions. After reading their intentions, we try to identify what is going to be the next move. So as I explained that in the case of GBB, they just come up to that of the initial low. They did not go. It is hardly about 20-30 pips. They can easily go above and breach. But that is not their intention. They wanted to just create the fear by gaining the level in the case of GBB, gaining the level in the case of Euro, and just wanted to create the fear. And then subsequently, they start making the slide. Actually, if you go in for the gap time trade, it will be a very quick trade. We can quickly book profit in a matter of about 30 to 45 minutes or maximum 1 hour. Then after putting down the initial lows and the highs, we try to find out what move they are trying to do it. Whether they are making a stop point or a false move or a gap time false move or session start stop point or a session close stop point. Because what they had done during that of 13:30 to 14 GMT is a session close stop point. And then false move during that of the gap time. And then from 14:30 GMT, they will make the intentional move. In another 2 minutes, we'll be able to see the real intention exposed. Then a quick move is always a false move, which can be a stop point or an extended move. And the intentional move will be 2 sessions and the start of the 3rd session. That indicates their real intentions. There is a question here. So I'll come to that of the trading so that you can just watch and compare what they are trying to do it. So I don't have any control over the other players, but I can only read their intentions. Keep that in mind. Then charge. GBB is below the initial low at 14:30. Can we take a buy? No, it is near the initial low, and if they don't breach the initial low till 14:30 GMT, 14:30 is the start of the US session. Till 15 GMT, they hold above 1.6710. When they are near that of the initial low, not breach the initial low for 30 minutes from 14:30 to 15 GMT, then we can take a buy. Definitely they'll make a rise, but they are not sustaining it there. It is not their intention. They wanted to create the bullish wheel, induce the short covering, and afterwards they wanted the profit. Then, see wealth. May you explain hedging again? Okay. Hedging is a facility available in the European and Australian trading platform, which is not available in all other platforms excepting the US platform where it is not permitted. Now, hedging is a mechanism wherein if you take a buy position in euro, then in the event if it drops, we are supposed to keep the stop. Instead, the hedging is an order which you keep it, and there in the MT4 trading platform, you come across a sell stop or buy stop. So you come across the pop-ups as sell limit and sell stop, buy limit and buy stop. So buy limit is to keep about 5-10 pips below the market and try to buy it. And buy stop is the one you will be able to place above the market. If you keep the buy limit above the market, it will reject. So we need to understand. So we don't have any capacity to place a higher level buy in the market, lower level sell in the market. That is only allowed in the bank terminals. That is why the players make use of the bank terminals to make all sorts of moves in the market. They can just push the currency on the downside or push it on the upside, whereas it is not possible with our online trading platforms. So when you keep the buy sell stop below that, that means when the market suddenly drops and fill it, we will have a lower level sell and a higher level buy. Two positions. Imagine that somebody has got a sell position and someone has got a buy position. Those two will think differently and perceive the market and try to exit of that. So you can think that way and try to exit off both the positions. And in that, I explained the procedures. That is, we use the hedging instead of stop. So we keep it instead of stop. And if that stop is not making profit for 10 to 30 minutes, that means they filled it during a stop or an extended move. And afterwards, it is not making profit at all for 30 minutes. That means they just reverse the market. So suppose if I am hedged at 37.70, for 30 minutes, they are not filled it. And it is making a loss of about 8-9 pips. So what I have to do is close it and keep another hedge order, 15-20 pips or 30 pips away from the market. Once they start dropping it, you lower the hedging order and to that of the original hedge level until you are able to keep stop at entry. So hedging is able to limit the risks and also you are able to compare it to that of the market, the hedge level as well as the original position level, whether to get really afraid of the market or whether you feel the market has reversed against your expectations. All those things you will be able to perceive. But if you use the stop would have closed your position and you become vexed that you have lost about 30 pips and you don't feel like looking into the market, you just go away from that other platform. Unless and otherwise you become addicted and continue to trade and earn money from that other market. So normally, if you make loss, you just hit the market. So that is a normal human tendency. So instead of use the hedge, you will be able to give an opportunity and find out whether the market is really making the intentional move against you or it is only a stop and or an extended move. You'll be able to identify and handle the hedging. In the event if the hedging is making profit, if the market goes against, that is the next possibility. In that case, you can keep stop at entry in the hedging. Suppose I got now this GBP is, the AUD is filled. Okay. The hedging is filled and I just watch for about 10 to 15 minutes and the hedging is not making profit. I just close it with 1 or 2 pips loss and keep another hedge order 10-15 pips above, depending upon the momentum of the market. Just taking an exposure for another 15 pips. I am not taking unlimited risk of not keeping the stop. Then if the market comes down, I lower my hedging order to 90-40 again. So that way, I'm able to handle my equity properly. I'm not taking unlimited risk. And then once the position makes profit, I keep stop at entry and do it. Suppose the market is reversed, the hedging is filled and the hedging is making consistently profit for 30 minutes. Then I understand, okay, my reading was wrong, the market has gone above and so my sell is making loss, the buy is making profit. So first step is keep stop at entry and watch. And they have got a limitation. They cannot endlessly rise. They can rise about 50 pips or 60 pips or 100 pips. If it is a complete intentional move on the upside, they can rise about 100 pips in the case of Australian dollar. After rising, what they have to do? They have to make an extended move upwards, opposite to that. Then I book profit on the hedge and keep another hedging order 30 pips above and start trailing it downward as they drop or during the extended move. So in that, I can take one more sell position and close both the sells below their average. Or I can simply trail the hedge order downward if I don't want to take any more exposure and continue to trail down the hedge order. If it is hedged again, then I'll try to book profit on the hedge side. Then again keep a high level hedge and trail it down until I am able to keep stop at entry in the sell side. Then book profit on the sell side. So it is not permanently the market is going to make an endless rise or endless drop. And they have to make the swings in the market. Especially this sort of trade will work very well in the case of Euro and GBP because they are volatile currencies. But other currencies, they make the one-sided move for some time. So you need the patience to handle it properly. Okay. Any other question? Okay. Do you do these type of gap time trades very often or only? Now I explained that my trade will be always position trade because I handle so many clients and also interact with so many people, etc. So I'll not be able to do the swing trade so easily. I do only the position trades. And I always aim for big profits and especially trend reversal to trend reversals, etc. So less position, more profit should be the approach. Then how long during a trade day we should look up the initial lows and the highs till end of the day, till 21:30 GMT, the end of your session. We have to use the initial lows and the highs and compare it with the other market. Okay. No more questions? So now you find that Euro started making the slide, then GBP is simply holding, and AUD started making the slide. So they are showing the true intentions now, the start of the European session. So the European session has started from 14:30 GMT. So they are expected to make the drop or slide for first 30 minutes. And in first 30 minutes itself, we'll be able to book profit. If the market move is slow, then you can book about 5-10 pips. And if it is a real intentional move on the downside that is slow, dip, pip by pip, if they cut and come below that of the initial low by 15 GMT, then we understand, okay, they are making an intentional move on the downside, keep stop at entry and maximize the profit on the downside. So that, in single position, we find out whether we can do a swing trade or a position trade. So it is not that I take one position and the market goes against and say that I'm doing position trade. That is not the appropriate way. Instead, you always aim for a swing trade. And when the going is good, then try to keep stop at entry and see that, okay, they are making the intentional move on the downside. Then try to use the trailing stop on one side and the trailing limit order on the other side, so that the market can close your position either filling the trailing stop or the trailing limit order or take profit order. That way, we'll be able to maximize the profit. In a controlled way, you have to do it. You can keep the trailing stop 15 pips away from that of the market, and you can keep the trailing limit about 30 pips away from that of the market and slowly trail it or manually change it. Manually change it, lower it, and see how exactly they are making the move and try to maximize the profit. So I had done it in the case of GBP during European session that way. Otherwise, we would have come back to that 67.10 again. So we should grab the profit. When the opportunity is seen, we have to grab it. And especially during the trend reversal, as I explained, it is a mid-month trend reversal. They do it once in a season. And so this month they are using it for that in order to build more buy position at the lower level. For that, they create the bullish field and then they wanted to drop it in a big way so that all the longs will be liquidated at the lower level. They will accumulate all the buy positions and later on continue to gain the levels. So you will be able to understand slowly after finishing it. We can give the market commentary after 2 months, but during the market time, we need to identify and we need to make use of and capture the profit out of them. There comes our skill set. Okay. Then Linda, can you make exact time for your session market for gap? It is 14 to 14:30 GMT is a gap time. Explain. 14 to 14:30 GMT is the gap time before the start of the US session. So now we are just finished 14:30, and if you see the GMT time frame, we are at 14:40 now. 5 minutes to complete the webinar. Hope you are able to understand, Linda. Then Ini. How about euro yen? Is it on a downward? See, as long as you wanted to trade in the process, first of all, you have to compare it with that of the majors. So when euro is making a positive net change and USDN is making positive net change, then they gain the levels in the case of euro yen. Then afterwards, when they show euro in negative net change and USDN in positive net change, then what happens? We can take a buy in USDN also now. This is what the level I had taken it during the European session, and they started reversing it. And they will not be able to do a downward stop below that. And you know that still it is above that of the initial high, 102.18. So we can take a buy. And later on, they will gain the levels in the case of yen. And if they drop euro, what happens? Then both the pips, that is on the positive side and the negative side of the numerator and the denominator. So euro is on the numerator side. When euro drops, the ratio comes down. When USDN goes up and when the value becomes bigger, then it goes up. So because USDN is a denominator, yen is a denominator against USD, whereas euro is a numerator against USD. So you find the negative impact USDN when it goes up, then euro yen will also go up. And when euro comes down, that will reduce it, and automatically you will find it is held at the same level or within the nominal swing of 20-30 pips. Whenever they make contrarian move, try to take positions. So now they are stalled euro rise and they are likely to gain USD yen. So you just watch and take sell position there. You will be able to get about 20-30 pips profit. But not a big deal because unless and otherwise they gain level in the case of euro, GBP as well as USD yen, they are not going to make big moves of 100 pips and things like that. That they have done it during the European session and Asian session. I was telling many people that you can take a buy in the case of GBP yen and euro yen. They made a very quick rise and just offloaded afterwards. So always keep in mind these are all nothing but the positions. So once the positions are taken, the players exit out of the positions with profit. They are interested in profit and not having any sentimental attachment to any currency for that matter. But their base currency is US dollar, so they don't let down the US dollar at any given time. Now, my euro position is making profit. Hope you're able to understand how gap time moves up also. And AUD, obviously it has not gone above. I don't know whether it is really filled because I was not looking into the code. And if it is filled and they're not making profit, you can simply close the hedge order and keep another 15 pips above the hedge order and try to watch. And if they start coming down, then we can simply keep stop at entry on the sell side and try to put profit during that. And if the equity is good, then if the hedging is filled and not making good profit, and if the spread is about 75 pips from that of the earlier entry or 150 pips from that of the earlier entry, you can do the averaging. See, I used to tell people that you can simply do the averaging every 150 pips, my mini lot, and in an equity of $10,000 or $15,000 account, and take only one currency and keep 150 pips away the sell orders whenever they are making a rise of this nature, and then keep 100 pips profit in them. You'll find that your sell orders will be filled and later on they will close your limit, and you don't require any skill to trade in the market. So we have to understand the limitations of the players. They cannot simply take the currencies to the infinite level by any chance. Okay, Linda, you made each 30 pips different based on what? I'm not able to clearly understand what Linda is asking. Can you please explain it? What do you intend to ask, please? Okay, sell or buy. No, it all depends, no? Especially I have mentioned in that sell position. So it is currently I have taken a sell position in the case of euro, and which is making about 7-8 pips profit. And this is again a sell position. I have mentioned it. Still, I have not got a clarity with regard to the question. Okay, fine. So, no more questions. Okay, I'll just conclude the webinar. You can just watch. I wanted to just say how the gap time moves or calls move so that you can just see how exactly they are making it. And you may call it as a New York session or the Pacific session and all those things. They are all meant for the herd of traders. So the herd of traders are given a set of informations and they are supposed to follow that and lose money. And don't join that herd. Try to use your common sense and try to see that you are really doing a business with the market, and in that you need to read the other man's intentions. Only 30 pips is different. Oh, you mean to say I only keep the hedge order 30 pips? Because I keep the hedge order 30 pips because they make only about 23 pips maximum a stop end, or sometimes 25 pips. Very rarely they make about 30 pips. So if you keep 30 pips hedge order or a stop, it is unlikely to be filled so easily. That is why. And the profit to start with 30 pips. And if the going is good, increase it to 45 pips or 75 pips. By trailing the take profit order, when the market going is good. Okay, then. Fine. So I take this opportunity to thank FX Trade for the facilities provided to give the Tracking the Forex Market Together webinar once a month. And this is the website address. I just, in case if you want to contact me and ask for any further questions, you can ask me using the email ID. Or you like to chat with me, this is the chat address, both Skype as well as Yahoo Chat. I am available. And there is no need to pay. And you can ask me. I will be able to help to understand the market. And later on, if the going is good, then you can trade on your own. And my phone numbers are also given. I'll come back on Thursday and give the Asian session live market analysis. I have given the forecast on Monday for this week, and I'll try to review it on Thursday and see what exactly the market has done, whether it has moved in line with the mid-month trend reversal or opposite of the expectations. Always we keep an open mind, and if it has moved, we'll try to perfect our algorithm and try to read the market properly. And if it moves in tandem, still we don't become overconfident, and we will not avoid using that strategic trading. Still, we will use the strategic trading of hedging to limit the risk, and use the trailing stop and the trailing take profit order in order to maximize the profit. Thank you one and all. See you on 20th Thursday. Wish you all the best in your trades. Thank you.